In this video, we are going to discuss about weighted average cost of capital, in short, WACC. So these are the steps in order to calculate the WACC. So the first step is calculate weights for each source of capital, then estimate the cost of each source of capital, multiply the proportion of each source of capital by that source of capital. So this is actually step number 1 into step number 2. Sum the result of the step 3 to give the WACC. All of the above can be summarized in the following formula, which will be provided to you in the exam. So we'll start with the calculation. See, there are two methods to calculate the WACC. One is called as the book value method, and the other book values, and the other is market values. So usually in exam they will specify which method you have to work out the problem. If they do not specify which method, you have to use market value. Okay, but it also depends upon the information given. If information is given for book value and they don't state anything like what WACC they want, then you have to do the book value because information is available for that. If information is available for market value but they don't specify which WACC they want, again you have to do the market value. In case they don't specify anything but you have all the information available, then you have to do the market value WACC. So that's about how you have to approach an exam problem. In case they are asking you to calculate market value weight of WACC, then the equity will be market value of each share into the total number of share in issue. If they ask you debt, it would be like total number of debentures into the current market value. So that is how you have to work it out. You will get the debt value, but we'll see it in the question also. Assume that you are required to value the book value WACC. In that case, the equity will be the equity share plus the reserve. Okay, debt will be like directly given there. So any debenture or loan, okay, or any bond, that will be like compromising, that will be like consisting of the debt part of it. So the reserve will not be is not required to be added in the market value here. Okay, don't add that because reserves are not to be added in the market value. Reserves have to be added in the book value. So that is a very important point. Ensure that you understand this. So here's a problem. We'll try to do this problem. So it states that Butchco has 1 million loan notes in issue. So quoted at 50 rupees per 100 nominal. So the market value is 50 and the nominal value is 100 for this loan note. They have 6,25,000 worth of preference shares. Each is of a nominal value of $1 but is quoted at a market value of 40 cents. And they have 5 million ordinary $1 shares, but the share price is at 25 cents. The cost of capital of these securities is 9, 12 and 18 respectively. This capital structure is to be maintained. He is asking us what's the book value WACC and the market value WACC. So what we'll do is first we will try to do the book value WACC. So we'll do a table for this. So the table would be the source of capital. Okay, then we need to find out the amount of capital, then we have to find out the proportion of capital, then the cost of it. Okay, so then we multiply the third and the fourth column together and we get this column's answer. So we'll start from the first one. We'll start from as per like how it's given in the question. We'll start from the loan. So loan, what's the total amount? They have 1 million loan note which is of $100 of nominal value. So they have given you that the total worth is 1 million. So you can directly take that 1 million. So we got the total amount as 1 million. So the next one is 625,000 preference shares. So preference shares, again, it's like directly given the worth. So 6,25,000 is the total worth. And how much of ordinary shares we have? Ordinary shares we have, equity shares we have 5 million. So 5 million into 1, if you do, okay, if you do 5 million into 1, you will reach up with the same 5 million. So that will be 5 million here, or 50 lakhs. And if there's any reserve, that has to be added. In this question it's not given, so just leave it. But reserve is an important part in the book value. You have to add that, or else your answer will be wrong. So now your job is to just add it, add all. The total comes to 66,25,000. Now we'll try to find out the proportion. So the proportion works like this: the 10 lakhs divided by 66,250 into 100, that will give you the proportion. Again, 6 lakhs 25, 1, 2, 3 divided by, so finally we have 50 lakhs divided by 66, 25, 1, 2, 3. So the answer will be 0.15, 0.09, 76 it comes to. When you add this, it should come to 1. Okay, so this comes to 1. We'll find out the cost. The cost is like directly given. This is problem. Okay, there is a 1 million loan note in issue, and the cost has been, like, I think it's given here. So the cost of capital of these securities is 9%, 12%, and 18%. So this is 9%, 12%, 18%. So now we'll multiply both and get the answer for the last column. So add all of them together. So if you add, you get 15.1%. Our book value WACC is 15.1%. So that's about the book value. So what you have to remember is the reserve is always being added in the book value method. So this is a very important part, and this is how it has to be like computed. So it's up to you whether to compute it in a table format, or you can also do it in a sentence format. That doesn't matter. You have to get the answer right. So we'll look at the market value here. The same question. We'll have the same approach to do it. So we'll start with the source, the market value WACC. So we'll start from that. We'll start from source, the amount of capital, the proportion of capital, and then we have the cost of the capital, and we have the third column into fourth column that we have to multiply. We'll get the answer. So we'll start from the same order. We'll start from loan. We'll do it. So loan, if you look at here, the loan is a 1 million loan note, but this is nominal value. Okay, and it says that the nominal value is 100, but the market value is 50. So we have to convert this. So what we'll do is we'll work it out here. So we have a 1 million loan note into each of it is quoted at 50, but the nominal value is 100. So divide this, you will get the answer. So this 1 million is a nominal value, this is nominal value. You divide them. Once you divide, you will get the number of loan notes, multiply by the value of loan note, the market value of loan note, each loan note, that is 50. So you will end up with this value. You will end up with this value. So the next one is preference shares. So preference shares, if we take, it's 6,25,000 worth, but that is nominal value because it's each was $1, but it's stated at 40 cents. So we can again put it like this. The value is 6,25,000, but this value is a nominal value, so we don't need nominal value. We need the market value. So we have to convert this. So if we convert, we get 2,50,000. Then we have the equity. So equity, if you take equity's value is 5 million shares, okay, which are traded at $1. Sorry, its nominal value is $1 and it's traded at 25 cents. So we can put like this: we have 5 million of shares which are trading in the market at 25 cents. So 5 million are traded at 0.25 value. That comes to so we'll take a proportion as like how we did in the earlier one. So we'll take 5 lakh by 20 lakh. Then we'll take 2,50,000 divided by 20 lakh. We have 12,50,000 divided by 20 lakh. So what would be our answer? Our answer will be for the first one as 0.25, the next one as 0.125, the last one as 0.625. So if you add, it should come to 1. The cost is like actually given here. It's 9%, 12% and 18%. Proportionately multiply them, you will get the answer. So it comes to 15%. So that's a market value of WACC. Okay, that is 15%. So that's how you do it. Okay, so here the good thing is you don't add the reserve. So just remember that the reserve is not added. So don't add it, and even if it's given the problem, don't add it. So that's about the market value WACC. So which is better? The market value WACC is always better when compared to the book value WACC. Okay, so that's how it works. So thank you very much for watching this video. We'll meet in the next video.